Warren Buffett is widely considered to be the greatest investor of all time. If you had placed $2,000 into his investing business when it first started, it would now be worth more than $60 million. Such profits may appear improbable, but how did Warren achieve them? He follows a few basic concepts that you may use in your daily life for great success. If you would like to learn them all, keep watching, so that you can use these concepts to improve your chances of success. Warren Buffett, Top 7 Rules for Investing. 1. 3 things to look for in hiring people: intelligence, initiative, and integrity. Warren Buffett looked for 3 things when they hire people: intelligence, energy or initiative, and integrity. If the candidate does not have the latter quality, it will kill you in the business world. If they lack integrity, you would want them dumb and lazy, not energetic and smart. 2. Huge opportunity exists when people act on emotions, instead of facts. Investors act in a very human manner. This implies that during bull markets, they become extremely happy and look in the rearview mirror and say, "Last year, I earned a profit. This year, I'm going to make more money, therefore I'll borrow money. You know, I wasn't in last year when that guy who was dumber than me made a lot of money," the neighbor continues, "so I'm going in this year." They are always gazing in the rearview mirror, and when they do, they notice a large sum of money having been created throughout the previous several years. Then, the people plow in and simply raise prices, and when they look in the rearview mirror and find no profit, they simply declare that this is a bad place to be. Ultimately, these types of people do not care what happens in the underlying firm. It's incredible, but it also creates a great opportunity. 3. Buy excellent businesses for a fair price, than a fair business for a wonderful price. Back around 1949, Warren Buffett was taught by Ben Graham to purchase things from a quantitative basis for things that are cheap, which made a big impression on him. As a result, Warren went about searching for the cigar, but method to stock investing. According to this idea, you're theoretically walking down the street looking for cigarette butts when you come across a horrible-looking, wet, ugly cigarette with one puff remaining in it, but you pick it up, and have your puff, which was dreadful. Then you toss it away, although it was free or inexpensive. Then you search the area for another one and repeat the process. That's what he did for years, which was a mistake, because you cannot find success with this method while using big money. Warren believes it's a lot simpler to purchase a fantastic company when you have a lot of money. So he would rather choose to the great business for a fair price, than a fair business at a great price. 4. Only purchase stocks if you know the economics of the business. Warren has an old-fashioned belief in that he only anticipates generating money in areas that he comprehends or understands. He doesn't mean understands in the sense that he knows the product details or anything like that. He refers to understanding the business's finances, and what it is likely to look like in the future in 10 to 20 years. For example, he is aware of what the economics will be like for Wrigley What chewing gum in 10 years. The way individuals chew gum will not alter as a result of the internet. It won't make a difference which gum they chew. You have double mint, juicy fruit, and spearmint if you own the chewing gum business in a large manner, but if he attempts to see forward on where the industry will be, he will not be far off because that type of business is within his inner circle of competence. He knows what they do, he knows the economics, and he knows the competitive elements of the business. 5. When given opportunities, take advantage of them. Warren's worst mistakes have been errors of omission rather than commission. He means that there were opportunities within the things that he knew enough about and were within his area of competence, but he was sucking his thumb, as he puts it, and not seizing the opportunity. Those are the opportunities that hurt him the most. They don't show up anywhere, and by not grabbing the chance, he estimates they cost Berkshire at least $5 billion. For instance, Fannie Mae was in difficulty 20 years ago or near to it, and Warren could have acquired the entire firm for next to nothing. If it was Microsoft, he wouldn't be concerned since Microsoft isn't within his inner circle of competency, so he does not think he has any entitlement to make money out of Microsoft, or cocoa beans, or whatever. But he knew enough about Fannie Mae to grasp what was going on, but he claims he blew it. This decision would never show up in traditional accounting, but he understands the cost and chose not to take it. Unless he informs you of his mistakes in the yearly report, you will be unaware of them. He believes omission is far more serious than commission. There are significant possibilities in life that must be taken advantage of. We don't do a lot of things, but when we do get the chance to do something that's big and right, we have got to do it, and doing it on a tiny scale is almost as big a mistake as never doing it at all. I mean, you're not going to get 500 great opportunities, so you'd be better off if you got a punch card with 20 punches when you graduate from school. With that punch card, you would use up a punch for each major financial move you made, and you became extremely wealthy as a result of your meticulous planning. For example, if you went to a cocktail party and heard about a company that you didn't know what they did or couldn't pronounce the name of, but they made some money in the past, and another one similar to it, you wouldn't buy it if you only had 20 punches on that card for major financial decisions in your life. 6. If the relationships with the businesses are good, don't sell. Warren will not sell any of his totally held enterprises, regardless of how much money is offered. For example, if someone gives him 3 times the value of anything he owns, he will not sell it, regardless of the company. Warren admits that he may be mistaken in his approach. He understands that owning 100% of Berkshire is not bad since that is how he wants to live his life. He has all of the money he will ever require. It all comes down to the wording of his obituary in the newspaper and the amount of money the foundation possesses. He does not want to break up with individuals he likes and the many individuals who have joined him because they believe it will be their everlasting home. To do so merely because someone hands him a large check would be like selling one of his children for the sake of a large check, hence he will not do so. He also wants to inform his partners that he will not be doing it, so that they would not be disappointed. He's using that technique more and more with specific equities. Now, if he were chronically short on cash and had a lot of opportunities coming his way, he might take a different approach. But his natural inclination is not to sell things unless he gets really frustrated, perhaps with the management, or if he believes the economic characteristics of the company aren't favorable, which occasionally happen. But he will not sell simply because the stock looks very high in all likelihood. 7. Purchase stocks that are below the value of the stock. Warren also will evaluate the stock based on its intrinsic value. The intrinsic worth of a business is the figure that you would get if you knew all there was to know about the future and could anticipate all the money a firm will provide you between now and Judgment Day, discounted at the right discount rate. This number is the intrinsic value of a business. To put it another way, the only purpose to invest and put money down now is to receive more money afterwards, right? That's what investing is all about, right? Now, when you look at a stock or a bond, it's quite easy to know what you're going to get, especially with US government bonds, since it says so right on the bond. It specifies when you will get the principal, and when you will get interest payments, making determining the bond's value quite simple. Although interest rates may change tomorrow, the cash flows are printed on the bond. The cash flows, on the other hand, are not printed on a stock. It's true whether you're buying a farm, an apartment, a house, or any other financial asset, even oil in the ground. You're putting money down now in order to gain more money afterwards. The question is when you will get it, how much you will get, and how confident you'll be. When Warren calculates a company's intrinsic worth, when he buys a company, and whether he's buying the whole thing or just a portion of it, he always assumes he's buying the whole thing because that's how he thinks. He examines it and wonders, what will come out of this enterprise, and when? When Warren assesses a company's intrinsic worth, or when he buys a company, whether he's buying the whole thing or just a portion of it, he always assumes he's buying the whole thing because that's how he thinks. He examines it and wonders what, if anything, will come of it and when. Of course, you want the company to be able to put the money they make to good use and generate better. Certificate. This is the analyst's job, to print out and convert that stock certificate, which represents a stake in the company, into a bond, and to say, this is what I anticipate it will pay out in the future. Warren is certainly thinking about that when he buys a new equipment for Shaw to create carpet, and you all learn that in business school, but it can also apply for big businesses too. Coca-Cola is currently valued at around $88 billion on the stock market. Would you pay up $88 billion now to receive what the Coca-Cola company would offer to you over the next 2 or 3 centuries if you had $88 billion in the market? As you move further out, the discount rate doesn't make much of a difference, but that is the question. How much money will they hand over to you? This isn't an issue of, say, how many analysts will suggest it or how much business it will generate. That is the only explanation. Returns as time goes on. Warren claims that Berkshire has never paid a dividend to its shareholders, but that its potential to do so improves as the value of the companies it owns rises. Warren can make it compound internally, but the fundamental question is, Berkshire Hathaway is now on the market for around $105 billion. Can it distribute enough cash to the shareholders soon enough to make it worthwhile to pay down that cash now, at current interest rates, if you're going to acquire the entire firm for $105 billion? That is, at the end of the day, what it is all about. You cannot buy the stock if you cannot answer that question. You may bet on the stock if you want to, or your neighbors can purchase it, but if you don't answer that question, which Warren couldn't answer for internet firms or many other companies, he will just stay away from those.